It's nearly the end of 2024, and I thought today would be a great day to be going over the 5 most valuable lessons that I've learned from long-term investing very specifically. So we should probably define what long-term investing is first before moving on. And that is, of course, buy and holds that are at minimum held for 1 year. Why is that? Well, that's just the way that the US tax code does define these sort of things. That's where you get preferential tax treatment, or just basically lower tax rates for holding things for that long. Of course, longer than that could also be very much better as well. but going on from there, I should give a bit of background to myself as well. Up until about 2022, I was primarily a short-term time frame trader. I didn't really look at time frames as far as trading goes above an hourly time frame, and I'd be in and out of positions within usually hours, and it's in some cases days. Now, when 2022 hit, that was obviously a big downturn in the markets, and I started to think in terms of long-term investing because, one, the markets had come down quite a fair bit. I think they're down about 15-20% at one point, and the way that I'd looked at things for the long term is that, well, if we see a major decline like that, anywhere between 10 to 20%, I'm happy to go in. I'm happy to go in, and this would be the time, if ever, for me to try my hand at long-term investing. So that's kind of the thought process that I was having at that time, and so I started to switch into doing both short-term time frame trading and then also higher-term time frame trading, which is more or less just investing, holding things for a very, very long time. I was doing this in both cryptocurrencies, or I shouldn't say cryptocurrencies because it's really just Bitcoin, and then of course US equities as well. And so it was really, really good timing during that time, obviously, but it does give me a kind of a unique perspective just because during that time, very specifically, we had, inflation running quite high. And well, when inflation was running quite high, what does that mean? It means that we had kind of a unique environment in which the markets, did rise up, but you were also losing the purchasing power of your US dollar. So I wanted to find a way to kind of account for that, because up until then, I really hadn't been thinking about long-term value preservation. It just didn't cross my mind. It wasn't something that I was super aware of. I did understand inflation, but I guess I never really fully thought it through and how it can compound over even a few years, even at 2%, that does start to eat up into a lot of your purchasing power, in 5, 6, 7 years. I mean, that's actually kind of a big deal. Anyways, so that's where I kind of got the idea. That's where I was kind of coming from. And that leads me into, well, the first lesson here, which is the account value all-time high. I know that I tend to, and this is really just all a massive note to self. So hopefully people find it valuable out there. But probably the biggest lesson that I have is that my account value's all-time high will never be the all-time high of my actual realized value. You can see in the chart right here, it's just a random one I pulled out from the internet. It actually perfectly illustrates this point. Kind of bit exaggerated here, but you see this massive spike in this account's value back on over in March, and then from there, leveled off and came down quite a fair bit. Now, during this time, I find it very easy for me to think, okay, my account value at that time it looks like it was about 6 or 7 million, and so that is how much money I have. That is how much money I have. That's who I am, and that's everything. And the second that it starts to go down from there, it's almost as if you feel, or at least I feel, like I'm owed back that money. It's like, no, that was mine. I need to get back to at least that, which is almost seen as break even at that point. And then I can take profits or whatever if you wanted to at that point. But yeah, moving on from there, just restating this in text, we have a tendency to identify our value with the highest total value of our investments at the ultimate top. But here's the thing, and here's kind of the lesson. Realistically, this will never be the actual account value realized. Why? Because, at least in my case, my profit taking is based off of in long-term investing, I should say, it's based off of an identification, an objective signal that identifies that the trend is unlikely to continue. And by definition, that signal that I'll get for that exit will never be at the all-time high. It cannot, because I'm waiting for an actual trend shift, and a trend shift naturally implies that, you must have, in this case, a lower low and a lower high. So that must come under, the ultimate top. It can't be any other way. So really, sitting down and meditating on this in kind of like providing like a tactical solution now, but sitting down and really meditating on this as my account's value when I take profit is going to be less than whatever the highest value was during, a given period. Well, that has helped me significantly, because then I have a less of a tendency to just blindly think that was mine, because it's not. That is just a fleeting number. It's not even real, because it's not realized, and it's also it's like a phantom, right? So for me, it was, again, coming back to that idea of really just sitting down and meditating on, okay, I cannot logically ever think to even have the all-time high value of that account. It cannot be that way. So if it can't be that way, don't worry about it that way. I also wanted to give an example of relative gains and losses, because I think this kind of goes hand in hand with it as well. And I think a lot of people deal with something like this, myself included, but just a hypothetical situation right here. You invest $10,000 into symbol shit, which is trading at $100. In 6 months, shit doubles to $200, thus making your investment worth $20,000. You decide to hold and shit. You decide to hold and shit for another 6 months. I don't know why I said and shit. Shit is now $150, and your original investment is worth $15,000. So did you make $5,000? Did you lose $5,000? Well, a lot of the time we have a tendency to, again, look at the difference between the all-time high value and then the current value as a loss. It's not a loss. Like this should be self-evident. It is not a loss, because it is a gain from the original investment that you did have. Is it the biggest gain that you could have possibly have? Well, no, obviously not. But was it even realistic to expect that to begin with? Again, no, unless if you have a better way than what I'm presenting here, or it's not that you have a better way, it's just a different way of I guess getting literally the all-time high, which really only one person gets to actually do. But fair enough. Maybe you take profits based off of percentage gained. Perhaps that could be it. At which point you're gonna think, if price continues in your favor after you close a trade, that, oh shit, I'm missing out on all this money. In fact, I had something like this very recently. I had a great trade, a great investment, which went up. I guess from the time that I started holding it, about 3 to 4x. But when I took profit, it actually went up another 2x from there. And I remember very vividly feeling like, fuck, I just lost that money. It's like, no, you didn't lose that money. You played out your strategy. You played out things in the way that they were meant to be done from, your own homework or my own homework. And well, that's just is what it is. And that's what is to be expected. So, of course, you made $5,000 in that prior example, and it is better to take profit now rather than wait and, hope that it goes back up to that all-time high value. The highest account value the highest account value you have will not ever be the amount of money you will realize. So that is sort of the tactical solution, again, to that, just meditating on that fact and realizing that it can't be that way. And you're always going to feel that way anyways. So just get over it, or at least don't give into it. Don't give into it by, of course, taking these illogical positions where, you try to get back, what was yours, because it's not yours. It's not fucking yours. Anyways, the next lesson is in relative risk. And this really goes back to, inflation, or, well, I mean, it goes back to a lot of things, but relative risk within the context of what I'm going to be bringing up here relates to inflation. So I asked Grok to make an infograph here of inflation's impact on the USD purchasing power, and it came up with a very interesting chart. I mean, the general trend is right, but I'm not sure why there's like two lines diverging here. Very bizarre. Anyways, as far as relative risk goes, one of the things that I really started to tune into in these last couple of years was inflation, and realizing that no matter what you have, whether that be stocks, commodities, forex, or fiat, I guess, real estate, or I guess that's everything. In fact, you have a position. You have a position in something that is moving. There is nothing that is steady. There's nothing that is a true store value. Even gold obviously moves in terms of price. But if you're holding cash, and the way that I kind of used to think about it is that, that's like a standard, just neutral position. It's not neutral. You're actually about -2% every year on average. Now, of course, recently that's been a lot more. So when I started to switch onto that, I started to realize, leaving a bunch of just, I guess, fiat currencies in my bank account is not a good idea. It's actually not a good idea, because I always used to hear these stories about, millionaires and billionaires who own a bunch of different stuff, but they don't actually have that much money in their bank account. And I was like, what are these fucking idiots doing? Like, why would you only have 6 months worth of expenses in your bank account when, something could happen to your investments, and then maybe you have nothing in the future? And then it wasn't until I started to tune into this where I started to realize, no, what's going on here is that if you hold fiat currencies, you are guaranteed to lose. You are guaranteed to lose a little bit every year, in some cases more. And again, the inflation numbers anyways are like probably lower than what it really is, because when you include other goods, but they don't include everything because, well, I guess it just makes more sense that way. But again, the point here is that everything is risky. Everything is risky, and holding a lot of fiat currencies is never going to be the best position, actually. The better position is to, of course, invest, a good amount of that. Maybe, I'd probably leave more than 6 months of expenses in my bank account, but a good amount should be invested, in the stock market, in Bitcoin, if you really want that as well. But just realizing that you are guaranteed to lose. You are guaranteed to lose due to inflation by holding fiat currencies. And in traditional markets, in traditional markets especially, with SPY, which is just your major index, your major stock standard index, you're not guaranteed, but on average, it returns 7 to 10% every year. So on average, that's what you could be making. That would obviously be beating inflation. And then versus on average for inflation, that's 2%. And that's, again, on the low end. You have to think to yourself, or at least I have to think to myself, what makes more sense? It makes more sense to be invested in the stock market. Of course, that does imply that you kind of have to, you do have to time things somewhat decently. And that, as I kind of alluded to earlier, with traditional markets, I just have a blind rule. If things decline 10%, I buy. If things just decline 15%, I buy again. If things decline 20%, I buy again. That's just what I do based off of the studying that I've done, which we'll get to a little bit later. Anyways, yes. Okay. So we've got that. Of course, stocks, crypto, commodities, they're also risky as well. They can decline, 20 to 30% in a given year. If it's, Bitcoin or crypto, 70%, or especially if it's like other cryptos, it can be 80, 90, 99%, in many cases. So that is also a risk, but of course it is a relative risk. And, usually if you have any fucking sense about you, you're going to have some sort of a stop loss, or some sort of an objective identification that this is unlikely to go in my favor much before it gets to 70% down. Maybe it's more like in Bitcoin terms, maybe like 20 to 30%, or in traditional markets, maybe it's like 5%. That to me would be acceptable. And again, that's a preferential thing. Anyways, moving on from there, lesson 3, and this one's probably going to piss off some people, but in my experience, diversification is bullshit. Why do I say that? Well, diversification essentially is trying to play all games at the same time with everyone, which is just, it's like intuitive to me. It does not make sense. You cannot be if you are focusing on a bunch of different fields, you cannot be as good as someone else who is singularly focused on one field. And it is a competition, it is a competition in a way. And then also just, there's usually just one sector going anyways, but we'll get to that a little bit later. Anyways, you cannot be an expert in all fields simultaneously, yet you are competing with others who are hyper-focused on a singular sector. Diversification does not work as well as many would intuitively think. It is better to hyper-focus on one sector or asset class and specialize in that rather than being slightly above average in many fields. And of course, I do make the caveat here that diversification can work in very high levels of asset management. When you're managing billions and billions of dollars, yeah, okay, it makes more sense to diversify there. But I think the game there is also a little bit different as well. They're less interested in making a bunch of money, but they're more interested in kind of hedging against losing the value of that money. Whereas if you're trying to make more money, if you're trying to increase your account's value, then diversification is not wise, at least in my experience. Now, of course, when it comes to crypto or even traditional markets as well, there's typically just one hot sector at a time, which is doing most of the major lifting, which forces the major indices up. Like that's the way that markets typically work. It's rotational sort of fashion, and one sector just becomes like a major winner, and everything else kind of like either holds value a little bit or might even go down a little bit as well. So that way, like not everything just gets like super overdone at the same time. It's just like one thing gets overdone and then another thing and then another thing, but they all have their turns, which kind of keeps that rotational market up. Anyways, as you probably already know, if you've been in this market for even a few years now, you can pull out examples with this for crypto. In 2017, it was ICOs. All you had to do was get into an ICO, and you're probably going to do well. It was the hot sector. In 2020, it was DeFi. You just buy whatever the fuck the DeFi things were at the time, like Aave and whatever. I'm not really like super well versed with these things, but DeFi was a hot sector, and most things in the DeFi sector just went to the fucking moon and beyond. 2021, NFTs, same shit there. How many of those NFTs just went to the absolute fucking moon that had, that just were, destined to crash somewhat soon after that. 2023, AI. 2024, memes. If we're just looking at the crypto market here, those have been the hot sectors. And so if you are going to diversify, the right way to diversify is to actually diversify into the hot sectors, because that's where you will actually get some sort of greater expected return, because you're just spreading your seeds everywhere, and it's hard to figure out which one's going to be the big winner. Of course, I mean, it'd be great if you could find exactly that one, but if you want to take a more, in my opinion, professional stance to that, finding the hot sector and then going into multiple different assets within that sector is going to be the way to really maximize having some pretty big gains while also minimizing your risk. Anyways, moving on from there, I should also mention, by the way, here under the tactics section, that hot sectors typically last anywhere between a few months, like let's say 3 months to a year plus in some cases as well. But, they all do have their expiration date, right? So do be aware of that as well. Anyways, lesson 4, study the history bar by bar. So this lesson really comes upon these sort of studies that I've been doing this past year, where I would just go way back in history on these very long-term charts, 50, 60, 70, 80, 100 plus years, and replay things. And the result really really spoke to me because I had to ask myself in a very honest tone to myself, talking to myself. Obviously, I have some sort of disorder, but I had to ask myself, when going back through these things, like, would I have traded this properly? Would I have made the right actions if I was in this situation? Because, things looked extremely bullish or extremely bearish. And the result kind of surprised me. So here I'm showing you a chart of the recent history of SPY, which is the major US indice. And I just want to focus on this area right here, especially over the past, let's say, 10 years, where it's been more or less vertical with, some pretty sharp corrections, but the trend is obviously very much your friend in this case. And I remember, especially back here in 2022, 2023 area, especially when the market was bottoming, there's many people looking at this, and myself included at the beginning. But once I started to do my studying, I did not think this way. But many people, myself included, looking at this and being like, this is a fucking crazy chart. This is a parabolic blow off top. This must come down. It must come down. Like, we're in for a bear market. It's been straight up for, over a decade. And that means that, this is a bubble. This is a bubble. And it looks like that from this picture. And obviously this is real time as well. So it could very well be a bubble, in hindsight. But let's compare that to some history here. Well, first, let's just go over this. SPY did about a 6x from the lows, about $1,000 to 6,500. Again, looks like a bubble, right? Exit all markets and go home. It's surely to crash, right? But when we go and look at other pieces of history, and I just picked out, the one preceding this current one that I just showed in the prior slide, you see that this is actually not crazy at all compared to history. This is a rally that was essentially going from about 1980 to 2000. And you can see here, the price of SPY was around $100 in 1980s. And where was it in 2000? It was 1500. I mean, these are tremendously major markets, major gains. And you can see in this market right here, like, this was just fucking vertical. Like, this doesn't look so crazy when you look at this. And so, when I look at this, it's like, shit, we could be right here. Not that these rallies have to be the same, but just, is this a bubble? It's like, no, it's not. This is just the world's strongest economy being the world's strongest economy. That's what it is. And so that was also very, very valuable to myself, and kind of focusing on these truths. And anyways, moving on from there, a 6x move for SPX is not something out of the ordinary. As you can see in the prior slide, there was a move from 100 to 1500. Was within the context of a 20-year just straight up trend, which we've almost had a 20-year straight up trend as well, to be fair. 2008 to 2024, it's pretty close. But in terms of returns, it's not all that crazy. So the lesson here, study both the returns and time for perspective. Without an anchor point, there is no objective analysis to be had. Things might look one way or another, but without an anchor to compare it to, then you will lack the important context for making the correct decision. And you probably know this yourself as well, because how many people were calling, the all-time high for Bitcoin this whole way up from the lows of 2023, because it's gone up too much, and it looks like a bubble. It looks like it's too parabolic. At some point, yeah, it is, but compared to the history, not really, not really yet, at least. So here's another tactic that I want to give you for this particular purpose, which is the bar replay feature. So this is what I like to do in my free time. This is what I like to do. I like to go to SPY, for example, and let's go to a weekly. So each and every bar represents 1 week of price action, and I'm gonna go all the way. Okay, that's a little bit too far. I'm gonna go all the way back here. We're going to come out of the low of 1942. Okay. And so what we're going to do is we are going to see, let me just launch it right there. Boom. Okay. Is we're going to just ask yourself as we go through this, would you have traded this properly? Would you have made the right decision? All right. So here's literally the low. If you'd have bought here, I mean, obviously the low was over here, but this was the low before like the mega rally began. So obviously if you bought here, you would have been the best of the best of the best, basically in terms of returns possible. If you're just looking at SPX and just going here again, each and every bar is 1 week. This like, a low doesn't even look like a low until well after the fact anyways. Like I'm clicking this shit as fast as I fucking can. Like let me actually zoom in right here because it probably doesn't register too much when I'm that zoomed out. But again, like all of these, you have to be asking yourself when you're in that moment, understand that this is a lot of time. This is a lot of fucking time. I mean, I've already gone at least a couple of years ahead now, and that's nothing on the charts as far as results go. All of these really just, I mean, to me, it really just says everything because look at this rally right here. Like it's so fucking crazy. It's such a fucking crazy rally. It really is. I'll spare you the rest of the details here because, that's going to take fucking forever. But you get the idea, and you can do that on TradingView. I don't know if it requires like a paid for account or something like that, but in my opinion, very much worth it. And you can see from there, this is what happens over the next 10, 20, 30, 40 years. You do have these corrections, and this is where I got my rule. Hey, if it's down 10%, I buy some. If it's down 20%, I also buy some. It's down, it's down 30%. Hopefully that doesn't happen. But of course, the idea would be to be out before that even happens, or not even invested anyways. But yeah, looking at this over the long term, and again, putting it not just on log scale, but on regular scale, you look at some of these rallies, and I would have been thinking it's a bubble too, not in this particular instance right here. Let me go to like this one. Again, just focus on the right-hand side. I would have thought this is a bubble. Like this is just craziness, right? This fucking rally is out of control. It's out of control. The 20-year rally after World War II, basically. And even from there, it gets crazier. Like it gets so fucking crazy. So what was the lesson here that I had? The lesson here that I had is one, study the history, because if you wouldn't have got it right in the past, you're probably not going to get it right in the future, to be fair. And just take note of how many times you thought, oh shit, this is definitely over. This thing's coming down hard, or the opposite. Like it must go up. It must be up. This is the most bullish thing I've ever seen in my life. That is just very revealing. And again, the lesson here, kind of like a secondary lesson, is this. Look, if you're going to be investing in traditional markets, there's like two major rules. One, find the country that owns the world reserve currency. It's actually what I'm getting to my next slide right here. Find the country, the world power with the reserve currency, who owns it, who controls it. Invest in whatever their major indice is there, and then if you can, find the hot sector as well. But right now, America is obviously the main player. It's got the world reserve currency, I should say, and what does that mean? It means just invest your fucking money in America until it's not, because we can expect these markets to likely continue. It's more likely to continue in just that general upwards fashion. Yes, there's going to be corrections. Yes, there's going to be bear markets along the way, but those are all buying opportunities. And it's really just a function of, can you hold, in traditional markets, could be 5 to 10 years, of a position, if you're in one of those downturns. If you can, it seems to me to be a no-brainer, because long-term it is going to return back to, more. And that's really all that it comes down to. And that's also a very pressure off way of kind of looking at it too. So try not to overthink it. At least I should tell myself, not to overthink it in those cases. And then last thing, or I mean, it is the last thing right here, but trend is everything. When it comes to long-term investing, I actually don't even care about, volatility momentum nearly as much as I do in my short-term trading. Yes, it does still matter a little bit. Volatility can be especially a great component in actually defining when you should buy or sell. And that can definitely have its place in profit taking and potentially even entry as well. But the trend is what matters primarily. If the trend is up over the long term, and again, you are investing in the country with the world reserve currency, then you're going to do well because you're at least going to be beating the inflation there. And for most, that's probably going to be good enough. It's probably going to be good enough for most. So I think that is where I want to end this video. A little bit longer than what I expected it to be, 30 minutes, bit of rambling here and there. And like I said, this is really a note to self that I can kind of look back to in the future. But again, we're just going over things really, really quickly here. Lesson 5, trend is everything. Invest in the world reserve currencies, major markets. Study the history bar by bar. You probably can't accurately identify, especially in the past, what the major bubbles and major opportunities were. It doesn't look like that at the time. Lesson 3, diversification, mostly bullshit. But if you're going to diversify in the hot sector, in different things than that, but not outside of that, because that's usually what's having most of the gains anyways. And relative risk, don't look at, or sorry, whoops, I'm going on completely the wrong note right there. But relative risk, again, realize that you're going to be, you're at risk no matter what you do. No matter what you do, you will have some sort of risk. Even if you're holding fiat currencies, the only way to have no risk is to literally have no money or no net worth at all. But that obviously carries its own real risk in real life as well. How the fuck do you plan to get around day to day? So that's obviously not the best option. And then of course, the last one is, looking at your account value all-time high, realizing that's not ever going to be your actual all-time high in your account value. It just can't be that way. It's not designed to be that way. So don't worry about it when it is, less when you take profit than your account's all-time high value, and realize that it's all a part of the plan. It's all a part of the plan. And that's where I'll end things for today. As always, I want to wish everyone the best. Take care, much love, and see you hopefully tomorrow.